All right. Well, good morning, everybody. For those of you that I haven't met yet, I'm Molly Stearns, and I'm the Chief Development Officer here at Overlake Medical Center. And on behalf of everyone on our foundation team, and thank you for joining us today for our Fall Circle of Excellence meeting. Today, we're going to hear an update from our guest speaker, Lorraine Del Prado, on how recent legislative changes could impact your financial and estate planning. In addition to our Donor Circle of Excellence members here today with us, we're also joining our members of our medical staff, and we're thrilled that so many of you could join, members of our Benefactor Society and other Overlake supporters. Again, welcome. By now, you're no doubt pros at virtual meetings, but just a few quick reminders. We've placed everyone on mute. So remember, if you want to ask a question, make sure that you unmute yourself. There will be time for questions at the end of the presentation. And for those of you who have questions during the presentation, please post them up on chat, and I'll be monitoring that and working with Lorraine. So there's a quick clarification. We can get that for you as we proceed. We are going to be recording the presentation today so that we can make it available for those who can't attend. And now I'm pleased to introduce Lorraine Del Prado. Lorraine, who you'll see full screen in a minute, but she's right there. Wave, Lorraine. Lorraine is Vice President at Thompson Associates, where she consults with nonprofit organizations, individuals, and wealth advisors on values-based estate planning. She's more than 25 years of experience in nonprofit development and charitable planning, and she's a frequent speaker on various issues related to philanthropy and purposeful estate planning. We have worked with Lorraine for, I think maybe 3 or 4 years now, and she brings a wealth of knowledge and information to us and the donors that we work with, and so we're thrilled that she could be here today. So Lorraine, I'm going to hand it over to you. And again, welcome, and so good to see so many faces on the screen.
Wonderful, thank you. And I just wanted to check if I'm now the host and I can share my screen, if it's allowing me to do that. If not, I think, Katie, we can just make use of the slide deck that you have. And you can just advance the slides. Is that possible? Sorry, we're running into some technical difficulties this morning.
There we go. Lorraine, the slide deck is up.
Great, thank you. Well, as Molly mentioned, there's been actually a flurry of legislation in the recent past that might be of interest to everyone with regard to financial, tax, and estate planning. Some of these pieces of legislation have already passed, such as the Secure Act of 2019 and the extension of the CARES Act until the end of 2021. But there are also proposals in Congress that will have quite a significant consequence on tax and estate planning, especially for high income earners. So the objective of this presentation is to alert you to these potential changes and also the changes already in effect from those laws that were passed recently, and how you may address the opportunities and challenges associated with these changes through charitable planning. An important disclosure, again, this is an educational service and I'm not providing professional tax or legal advice. And again, all the illustrations I'm also providing here are just conceptual in nature. So you need to really consult your independent professional tax or legal advisor about the consequences of this, of all that I'm talking about on your particular situation. All right, so again, our agenda today, next slide. Okay, is to review the implications of the following legislation, the Democratic tax reform proposals, and I'll be focusing on the proposal that has been approved by the House Ways and Means Committee. There are other proposals that have been introduced in the Senate, such as the Senator Bernie Sanders 99.5% Act and the STEP Act of Senator Van Hollen and Senator Elizabeth Warren's Wealth Act. And those I'm not really focusing on so much because the House Ways and Means bill is what's giving us a barometer of what the appetite may be of the Democrats. And then there's the CARES Act extension 2021, and again, the SECURE Act, which had changes to estate planning for retirement plans. So let's take a look first at the House Ways and Means Reconciliation Bill, which is the funding mechanism for President Biden's Build Back Better initiative. So what are the reasons for reform in our tax system that were put forward by the Democrats? First, they want to level the playing field because they think that there is this huge wealth inequality that our tax system seems to be contributing toward. So they're asking the wealthiest to pay their fair share of taxes, ensuring too that working people are not paying taxes at a higher rate than the wealthy. And they want to close tax loopholes that enable the wealthy to avoid estate taxes and capital gains taxes multi-generationally. And most importantly, the tax reforms are there to increase revenue to pay for the infrastructure and social programs in the Build Back Better initiative. Okay, so let's start with the income tax reform proposals of the House Ways and Means bill. And for all these proposals also, we need to really take a look at when they become effective, because some are effective next year. So after December 31, 2021, there are some proposals that are actually effective by September 13, 2021, which is when the proposal was first reported out. And other proposals will be effective during the bill's enactment. So for income tax reforms, that will be in 2021. So there's an increase of the marginal tax bracket of the highest earners from 37% to 39.6%. For those who are earning $450,000 or more, if they're married filing jointly, and for $400,000 for single filers. So this actually drops the threshold for the highest income tax bracket from what it is this year, which is over $500,000 to about $450,000. There will also be a surcharge tax equal to 3% of modified adjusted gross income for those earning more than $5 million. And then for income in trusts and estates, if those entities actually earn more than $100,000. And then the net investment tax will now also cover earnings from a trade or business that's in excess of $500,000 for married couples filing jointly, and then $400,000 for single filers. And with regard to the qualified business deductions for individuals filing jointly, there's now a cap of $500,000. And then finally, and I suppose most importantly, is the graduated increase in corporate tax rate. So there's an 18% tax rate on the first between first 400,000 of income, and then from between 400,000 and 5 million is 21%, and then 21% for up to 5 million, and then 26.5% for income above 5 million. So this is interesting that it's a graduated tax that they're proposing. And the New York Times today, Senator Manchin was reported as actually supporting a 25% corporate tax rate increase. Okay, so from income tax rate, let's get into capital gains tax reform. So the proposal in the House would increase long-term capital gains and qualified dividend tax rate from 20% for, again, highest income earners to 25% for the tax years ending after September 13, 2021. So this is where it's tricky because it's already passed. So for those transactions or sales that have happened before September 13, 2021, then you still have the 20% tax rate. But if it's after, then there is the 25% tax rate. Now, it's interesting that the proposals did not mention the more controversial suggestions that were within President Biden's original proposal, which is to do away with a step up in basis at death. So that was not mentioned in this bill, and also not mentioned in this bill is the forced recognition of unrealized gains in non-grantor trusts every 21 years, or for appreciated assets when they are transferred at death beyond $1 million exemption or the $250,000 principal residence. So that's good news because that would have been really a nightmare to implement. And then gift and estate tax reforms. So currently we have an 11.7 million per person exemption from gift and estate taxes. So these are transfers during your life and at your death above the tax-free gifting. So we have 11.7 million, and there's a 40% tax rate applied for every dollar above that. So this is set to sunset in 2025. And then in 2026, it becomes 6 million. But with this proposal of the House Ways and Means Committee, it accelerates the sunset so that the 6 million reduced exemption will now be effective in 2022. So that'll be 6 million per person, 12 million for married couples. And then also quite controversially, the bill would end popular estate tax reduction techniques that are being used by wealthy taxpayers and business owners. And this time, that the end of those techniques would be effective by the loss enactment, so the date of the loss enactment. So particularly grantor trusts, where the grantor will pay income for the earnings of the assets in the trust, but the assets are no longer included in the taxable estate, will now be subject to estate taxes. And so that severely limits the effectiveness of the GRATs, your grantor retained annuity trusts, the qualified personal residence trusts, SLATs, and the irrevocable life insurance trusts. So this time, the appreciation that would not be subject to estate taxes with the heirs will now be subject to estate taxes. Also, sales between grantors and trusts will now be subject to income taxes where they aren't currently, because the reasoning being it's the same taxpayer, so there's no income tax that is recognized, but under this law, yes. And then also valuation discounts for non-business assets transferred to entities like limited liability companies and family limited partnerships. So if you have a portfolio of securities that you are transferring here and reasoning that there is a lack of marketability and lack of control that would necessitate the valuation discounts for tax purposes, that will end. And finally, also rules related to retirement plans. So first, it prohibits contributions to traditional IRAs or Roths when the accounts exceed $10 million at the end of the prior taxable year. And then there will also increase minimum required distributions for high income taxpayers with retirement account balances exceeding $10 million. So the objective is again to empty out these accounts so that revenue will be raised through income taxes. And then it will also prohibit backdoor Roth conversions for high income taxpayers. So currently you cannot start a Roth if you have income in excess of $200,000+, but you can still get into a Roth backdoor by converting a traditional IRA into a Roth and just paying the income taxes. So now this will be prohibited. And it will also prohibit IRA investments in certain non-publicly traded entities. Okay. So a lot of proposals. And of course, I don't have a crystal ball, so I don't know whether there'll be enough votes. There'll still be a lot of refinement to the language and the implementation should this bill pass. And of course, there'll be a companion bill in the Senate, and then any differences will be reconciled in conference committee. What the effective date, will the laws change in the future? You know, all of those things we cannot say. But it'd be good for you to just know that this may be coming, and it may be reason for you to do some proactive planning. All right, so this actually may be the golden age of charitable planning or planned giving, because in a landscape like this, which has increases in capital gains taxes, in income taxes, in gift and estate taxes, or the reduction of exemptions from gift and estate taxes, we have all of these charitable planning techniques that actually address these problems, whether it is avoiding or reducing capital gains tax, generating some income tax savings that you can coordinate with Roth conversions or unusual income events like deferred compensation, or when you're exercising options, or even offsetting capital gains tax liability. When you are passing IRD assets like IRAs or 401ks at death, charitable planning can also avoid or reduce the income taxes that will be paid by your heirs upon receipt of these assets. The reduction and avoidance of federal and state estate taxes can also be achieved through some charitable strategies. The minimization of gift taxes, and also the ability to diversify the inheritance of your heirs through a combination of an outright bequest with an income stream, and perhaps a deferred gift, like through a charitable deed trust. And then finally, asset protection. So a lot of the charitable strategies are in the form of trusts that would protect the assets from divorce, litigation, creditors, and bankruptcy. Okay, so let's take a look at some simple charitable tools that high-income earners can actually use especially this year, to reduce their taxes. So for 2021, there has been an extension of the CARES Act that has some really very attractive charitable incentives for people who make gifts to public charities like Overlake. And if you're contributing cash to a public charity like Overlake, you can use your tax deduction up to 100% of your adjusted gross income, where normally it would be 60% of your adjusted gross income. So there's a lot more tax savings that you can realize in 1 year if you take advantage of these cash contributions in 2021. And of course, you can contribute appreciated stock to charitable organizations and benefit from the double tax savings of ordinary income tax deduction, as well as capital gains tax avoidance. So that's always very attractive any year. And if you want to take advantage of your itemized deductions, especially if you're afraid that they may be capped in future years, with some proposals in Congress actually capping the benefits to 28% instead of whatever the highest marginal tax rate is. This might be a time to bundle or accelerate your charitable donations. A lot of people do this by actually bundling the donations to their favorite charities, or bundling their donations to a donor advised fund if they haven't chosen what their charities will be at, and then distributing to those charities in the following years. And the time that they bundle those donations and contribute them to the donor advised fund, they can take advantage of a significant income tax deduction. And if you are 70 and a half or older and you have a traditional IRA, you can make charitable qualified distributions or qualified charitable distributions, what we call charitable IRA rollover to public charities. And those distributions will not be included in your taxable income. And it will also count toward your required minimum distribution. And finally, you can combine a charitable donation with a Roth IRA conversion. So the charitable donation will provide an income tax deduction that will help offset some or all of the income tax liability of the Roth IRA conversion. And of course, once you have the Roth IRA distributions from this will not be taxable income in the future. All right. So now let's move on to a charitable strategy that is a good solution for the increase in the capital gains tax rates, and that is called the Charitable Remainder Trust. So a simple way of looking at a charitable remainder trust is using the analogy of a tree with its fruit. So during the trust term, the donor or the donor's family will be receiving the fruit of the tree. And then at the end of the trust term, both the fruit and the tree go to charity. So this is a tax-exempt and irrevocable trust that's funded by you either during your life or at your death. And during the trust term, it provides a fixed payout or an annuity to one or more beneficiaries. And the term could be for their lives or for a term of years not to exceed 20 or for a combination. And again, after the trust term, the remaining assets go to charity. And it provides a charitable income tax deduction to the donor. And then there's also the tax-free investment environment, which means that if you have any appreciated assets that are sold in this trust, they do not pay capital gains taxes. Okay, so let's take a look at a case study. Here's Mary, who owns 1.4 million in appreciated stock with an original cost basis of 100,000. So our assumptions are that the House Ways and Means bill has passed, so the capital gains tax rate is 25%, but we can't forget the 3.8% Medicare surtax, right? So that's a 28.8% tax rate. And wait a moment, remember Washington State has actually passed a new capital gains tax rate of 7% for the state. And these, as I understand it, stock portfolios are not exempt. So the total tax hit for Mary then would be 35.8%. So the sale of the 1.4 million in stock will result in $465,400 in taxes. And that's actually including state taxes. That's a typo over there. So Mary's goals are to reduce taxes. She wants to increase her retirement income. She has twins that she would like to provide for as well. And she likes to make a gift to charitable causes, one of which is Overlake Hospital. All right, so let's take a look at how the Charitable Remainder Trust works. So a donor like Mary will actually contribute assets to a Charitable Remainder Trust and receive an income tax deduction, and also her estate will receive a charitable estate tax deduction. During the trust term, the trust will sell the asset without paying the capital gains tax, and then the trust will distribute a fixed percentage of the trust assets or a fixed amount to the income beneficiaries. So, so it could be for a 20-year term or for their lives or a combination. And then after the term, the remaining assets go to a charity or a group of charities. So in Mary's situation, she contributes the $1.4 million in stock to the Charitable Remainder Trust and avoids paying $465,400 in capital gains taxes. So again, that's the federal plus the Medicare surtax plus the Washington state tax. In addition, she'll be receiving an income tax deduction of $237,076 that she can make use of up to 30% of her adjusted gross income. Whatever she can't make use of in 1 year, she can carry forward for an additional 5 years. During the trust term, the trust will sell the stock without paying capital gains tax and will be distributing 5% a year. So the first year would be $70,000. And if our assumptions are correct that the trust assets on average will grow by 7%, then she and her children will be receiving a little bit more than $5 million before tax during the trust term, which is for Mary's life, and then 20 years after her death, it will go to her twin children. And then after the trust term, she is able to leave quite a magnificent legacy of $3.4 million to her favorite charities. So the benefits that Mary was able to realize from a charitable remainder trust is the avoidance of capital gains tax. The tax deduction also allowed her to save income taxes. She provided an income stream for herself as supplementary retirement, and then for her children as a form of inheritance. And the assets in the trust are also protected from creditors' liability and divorce. And of course, she created a wonderful legacy for charitable organizations after she was able to take care of her family. All right, so that is the charitable remainder trust, a good solution for avoiding the quite confiscatory capital gains taxes that we may be facing next year. Okay, so now let's move on to a solution for the decrease or the sunsetting of the estate tax exemption. So what happens when the exemption is now $6 million per person, $12 million per couple, and if you own more than that. So we'll be taking a look at the charitable lead trust, which in a way is the reverse of a charitable remainder trust. So so again, just a summary. So the federal estate tax exemption is $11.7 million today, and it's set to sunset in 2025. But under the Ways and Means bill, that will get accelerated to 2022. All right. So it's important in doing estate planning that you use 3 fundamental tools to reduce your gift and estate taxes. First, making sure that you make full use of your estate tax exemptions. And that could be leveraged through freezing, discounting, and also split interest techniques that you can talk to your attorneys about. And then also make use, if you're married, and you have a U.S. citizen spouse, unlimited marital deduction, which would basically postpone the payment of taxes until the second death. And then you'll have the charitable deduction, which provides a dollar-for-dollar reduction in estate taxes. So these are the tools, and if you cannot limit your taxation with the use of the exemption and limited marital deduction, then strategies like a charitable lead trust, which provides a charitable deduction, can become very attractive. So charitable lead trust, again, using the tree and fruit analogy, during the trust term, this time the fruit of the tree actually goes to charity, and at the end of the trust term, your family will receive the tree and its fruit. So again, it's an irrevocable transfer to a trust that can be funded during your life or at your death. And it's designed to provide a fixed payout. So we're looking at the charitable lead annuity trust. So it's a fixed payout to a charity or charities for a fixed period of time, whether it's a term of years or the lives of the donor. After the trust term, the remaining assets go to the family members, if it's a non-grantor lead trust, which is what we will be talking about, or back to the donor if it's a grantor lead trust. And it provides a gift and estate tax deduction that would basically lower the gift taxes paid for the transfer that will eventually be going to the family. And when interest rates are low, like what we have right now, this becomes very advantageous because the value of the annuity interest going to the charity is higher in the eyes of the IRS. Okay, so let's take a look at how this works. So you have donors who are actually transferring an asset to a charitable lead trust for a term of years. At the end of the term, those assets will go to the family. So during the lead trust term, the trust will distribute a fixed payout to one or several charities. And because of doing this, the donor will be receiving a charitable gift tax deduction. And at the end of the trust term, the assets go to the family, but the gift tax deduction reduces what the gift tax liability is, and may even be able to zero that out. So let's take a look at a case study here of Barry and Sarah Rich, and they wish to transfer $3 million to a trust for the benefit of their children, but they're worried about both federal gift and estate taxes and state estate taxes here in Washington. And they also wish to support a couple of charities that they volunteer for, that they serve as trustees at. And they wish to inculcate also these wonderful humanitarian and charitable values in their children and grandchildren. And our assumptions are they own 15 million, so that's 3 million more than the 12 million that they're able to exempt from gift and estate taxes starting next year. And then we're also assuming that we'll continue to have the 2,193,000 exemption per person for estate taxes here in Washington. And then whatever is above that will be subject to a 10 to 20% tax rate. Okay, so let's take a look at what they do if they transfer the $3 million to a charitable lead annuity trust for a term of 20 years, and they choose a 5.5% payout, which basically translates to $165,000 a year to their favorite charities. So that payout would produce a gift tax deduction of $3 million. So which basically zeroes out what goes to their family in the eyes of the IRS as being a taxable gift. So at the end of the trust term, the family will get the $3 million that's in the trust plus 1.8 million in tax-free growth. And that's based on an assumption of a 7% net investment return happening inside the trust. So that's the investment growth that we're anticipating. So that's a good way of transferring assets to the family at highly reduced tax costs. In fact, it's zeroing it out, and also providing a nice benefit to charity that the donors can witness and their family can witness during the trust term. Okay, so the benefits of a charitable lead annuity trust, so again, enables transfer of assets of great value to heirs at a minimal or it could even zero out gift and estate taxes. It helps diversify the inheritance of the heirs by providing them with that deferred lump sum. So just in case your heirs actually do not make good investment decisions and deplete their inheritance, there's another inheritance 20 years from now that they can rely on. It benefits charities over a term of years. And then during the trust term, you're training your children the values of philanthropy and civic involvement. And you could also ask the trustee of the charitable lead trust to help train children on investment management. So the children know about what decisions are made with regard to the asset allocation of the trust assets that will have an impact on the size of their inheritance at the end of the trust term. Now, as I mentioned earlier, the charitable lead trust can be done during your life, and it could also be done at your death. So what some attorneys are doing is actually using it as a safety net, as a testamentary charitable lead trust. So if ever at your death or at the second death, if you're married, there is a significant amount that would be subject to state or estate taxes, then that amount would go into a charitable lead trust for a period of time and for whatever annuity is enough to zero out the taxes. And at the end of that trust term, it will go to your heirs. So this is a nice way of zeroing out estate taxes. If there are no estate taxes that are due at the second death, then the charitable you don't need for this charitable lead trust to spring into action. So it could be placed as a contingent charitable lead trust. All right. So now let's move on to the Secure Act and what might you consider in terms of estate planning for your IRAs? Okay, so just a review that whatever is left in your IRAs and retirement assets at your death will be subject to 2 layers of tax. So it will be subject to estate taxes at the federal and state level if you have a taxable estate, and it will also be subject to income taxes. So a federal income tax and state income taxes for some states. We don't have that right now. So even if you don't have a taxable estate, whatever is left in your IRA will still be subject to federal income taxes. Now, a wonderful way of avoiding all those taxes is giving your IRA to charities, because charities are tax exempt. So the IRA then will avoid both estate taxes and income taxes. But for a great number of us, our IRAs are actually a considerable portion of our net worth, and therefore we are interested in making sure that our children can benefit from these IRAs. But that has changed since the Secure Act was passed. So let's take a look at the Secure Act, which is the Setting Every Community Up for Retirement Enhancement Act. And it had some very positive benefits for retirement planning. It raised the required minimum distribution age to 72. It removed the maximum age for us making contributions to our IRAs. A lot more part-time employees now can qualify for 401k plans. And it also helped small businesses offer retirement plans. However, there was one big negative, and that stretch IRAs, as we know it, the ability for heirs to actually receive inherited IRAs over their lifetimes, was practically eliminated, except for a very discrete number of beneficiaries. So let's take a look. So IRA distributions over life expectancy now are only limited to the surviving spouse, a disabled or chronically ill child, a minor until that minor turns 18, and then a beneficiary who is less than 10 years younger than the IRA owner. So for all other folks who inherit IRAs, they must withdraw those assets within 10 years of the IRA owner's death. So what are the implications of this? Here's a chart that was created by Bernstein Porter that shows what the difference in the economic benefits would be between the stretch IRA, which is now gone basically for most of the beneficiaries, and the Secure Act. So the orange bars represent the distributions over the life expectancy of a 55-year-old for $1 million IRA. So assuming a 7% annual return. And then the gray bars here represent the distributions after the Secure Act. So you could see that the heirs would be benefiting less from the tax-deferred growth and from the distributions. Okay, so one smart alternative to the 10-year distribution from the IRA is a testamentary charitable remainder trust. So what we talked about earlier, but this time done at death, which is what I call the charitable stretch IRA. So upon the death of the retirement plan owner, the IRA assets go to a trust, a testamentary charitable remainder trust, and it will distribute a fixed percentage of trust assets or a fixed amount to your heirs for a term of years not to exceed 20 or for their lives. And the estate will receive an estate tax deduction for that gift. And at the end of the trust term, the assets in the trust will go to your charities. So here's an example, again, of that 1 million IRA for 55-year-old. So it's transferred to a testamentary charitable remainder trust, and the heir receives 50,000 in the first year, around 2.5 million over life, which is 35 years, 1.9 million after tax. And then the estate receives a charitable estate tax deduction of $321,000. After the trust term, the assets in the trust will go to a charity, and that's a nice legacy of $1.9 million. So, a great alternative to just taking withdrawals over 10 years. So the benefits of a testamentary charitable remainder trust, so it prevents that lump sum distribution of retirement assets to heirs. Some heirs might want to do it in 1 year as opposed to 10 years. So it avoids immediate taxation of the retirement plan assets. So instead, heirs pay income taxes as they receive the annual payout. It holds assets again in trust, so providing asset protection from divorce, litigation, bankruptcy, and creditors. It provides a tax-free investment environment. That's very powerful. So the assets in the trust continue to grow tax-free, so the heirs, of course, benefit from the distributions during that term. And the distributions become like a supplementary retirement source for them. And then the estate gets a deduction, and again, providing a deferred benefit to your beloved charities after taking care of the family. All right, so a lot of strategies. And so you might say, how can you navigate all these opportunities? So definitely do not do this yourself. So make sure that you get guidance from a team of advisors, your CPA, your wealth advisor, your estate planning attorney. And I encourage you to include a philanthropic advisor because of the powerful applications of charitable strategies. And one thing that we're asking you to consider is also take advantage of the special service that would guide you in navigating these opportunities that's provided by Overlake. And that's the Thompson Values-Based Estate Planning process, where I serve as Overlake's Thompson consultant. So it is a complimentary service and it's confidential. So even though it's Overlake that's paying for my fees, all our conversations will not be divulged to Overlake. I'm not selling any products. I'm not soliciting any gifts. I'm not also drafting any documents, and it's conducted at your own pace. And whatever recommendations we provide, you have no obligation to implement them. But a lot of the people who go through this process do implement them with the help of their professional advisors. So what we do is basically clarify your values, objectives, and desired outcomes and let those drive your plan. We help you organize your financial assets, and then we take a look at what might be some tax issues. We educate you on options, on how to create a plan that is in alignment with your objectives and that reduces taxes. And we illustrate various recommendations versus your current plan, and help you create a plan. So you're in charge, and you choose the components that will be in your plan, and we prepare final recommendations and a packet for your attorney. And we can interface with your advisors and family as necessary. So what would this look like? So here's an example of one of my clients, a very, very high net worth person with a huge estate that was subject to federal estate taxes and state estate taxes, where 44% would have gone to the government and 56% to heirs. And then after going through our plan, we actually increased what was going to heirs over time to 80%, and we redirected what would have gone to the government to charity. So there's 18% going to charity, and then only 4% going to the government. And here's another example, this time a physician with a huge IRA. and where originally 36% would have gone to the government and 2% to charity and 62% to heirs. We increased what was going to heirs to 66%, and then 28% to charity, and then 6% to government. So this is just an example of what the results may be from the planning process. And if you're interested in taking advantage of this or just meeting with me for the first time to see if this is something appropriate for you, then please contact Lori Ramachi-Nagel at her email right here or her phone number. Okay, and with that, we will now open the floor to questions. And I don't know if we were able to get an attorney. We actually invited an attorney to help here, and that's why we said the attorney contact information that you can ignore if that attorney is actually present. Any questions?
Well, Lorraine, that was a lot. Thank you. Take a deep breath. That was quite impressive how you rolled through that deck without stopping. I think that this is such great information, and we will be sending this a recording out to everybody. We can also send the deck so you can further study this. If you're like me, you probably have to, go run through it one more time to really truly pick up on all that was presented and all these changes that some of which will no doubt be enacted. And our offer at the foundation is there. We would, anyone who wants to meet with Lorraine to explore a Thompson process or just ask some questions, we are happy to offer that. And again, when we send out the recording of the presentation, there'll be more. We'll repeat Lori's contact information again, so you'll have that. I do see some questions. Jim Robinson.
Yes, I would prefer the deck.
Okay.
You could send out the deck.
Okay. Totally.
There was a lot of information, well presented, I might add. But what's sort of scary here is we're not too sure what's going to pass in Congress, especially with capital gains. My goodness, sounds like capital gains is gone. All the potential taxes. So anyway, just the deck would be great. Thank you.
We will provide both to take care of the visual and the auditory learners. I agree, Jim. I'm with you. I'm a visual. Okay. Any other?
And I just wanted to give a date out there that's available for meetings, and that's Monday, November 15th. And I have a lot of availability that day should you want to take advantage of a first meeting.
Okay. All right. Any other questions before we end? Again, thank you so much to all of you who have joined us. Lorraine, thank you. We're so grateful for all that you do for the community and for Overlake and our Overlake community. It's just really wonderful to have you as part of our team as we work on behalf of our greater community. So I guess what we'll say goodbye. Thank you again to all of our Circle of Excellence members, our Benefactor Society members, our medical staff members who could join us, and everyone else who was able to join with us today. And enjoy the sun. I think it's the last time we're going to see it for a while. So get out there and take a walk. Take care, everybody, and thanks again.
Thank you. Bye.
Bye.